Yeah, I do feel like I'm training for a mixed martial arts competition here. But look, I think the obvious thing is we kind of bounce around here for a while. What's a while mean? It means probably a couple of weeks. We've got to get through the pre-announcement season for earnings, and then really see, Scott, because as you know, and you and I debate, there's a big question about what earnings really are. The estimates on the macro level have hung in there and actually even gone up week over week. And I know that defies a lot of belief, so we're going to have to see as the results come in if the macro analysts are out of their minds or if actually the economy and corporate profits are a lot better than people are giving credit for. I will note that it seems like you've got negatives and positives, right? We get a pre-announcement from Target a few weeks ago that was awful. This morning you get a pre-announcement from U.S. Steel. I mean, this is a hard asset, old line economy stock, but it was a pretty darn positive announcement. And, you know, when I think about economic growth, I think about steel. So we got to see as the results come in.
The problem is, I mean, these earnings expectations or estimates, if you want to call them that, they don't just seem to defy belief. They defy logic, right, Jim? Given sort of where we are, you look at every economic metric that's been coming out, it's been weakening. There are real doubts about how long the strength of what feels like a pretty strong consumer, at least what was a strong consumer, can last, given everything that's going on around them.
Yeah, so I'll acknowledge what you just said. The economic statistics have been coming in disappointing. But I would say not as disappointing as maybe the headlines would lead you to believe. If I look at today's industrial production or Wednesday's retail sales, they did miss expectations, but only by a few tenths of a percentage point in each case. So it was not a dramatic, like, falling off a cliff. With regards to the heart of the economy, which is consumption and the consumer, ultimately that test is going to be met or failed by what jobs do. And I take some comfort not just from where initial jobless claims are, but where from continuing claims are, which is at or near a 50-year low. And that's indicating that there are a lot of job openings. So as people get laid off, and we're seeing the layoff announcements, there are plenty of job openings for them to go to. Ultimately, if that hangs in there, note I use the preposition if. If that hangs in there, this economy can do just fine.
So you have
big if, but
you have a big price target for the S&P still, 48.96 or thereabouts. Is that about right?
That's correct, Scott.
Okay. Now, let me ask you this. Let me ask you this, because it seems to me your whole case for that is predicated on your scenario playing out, that there will not, in fact, be a recession. I want you to listen to what Professor Siegel told me yesterday in overtime about that very question.
We're in a recession. It's a mild recession. It's not an official recession by the NBER, certainly not yet. But this first half is negative GDP growth, and it's ending on a slide. And, just when the Fed is, the most aggressive because it waited far too long.
Yeah, so throw your textbook definitions out. That's what the professor says. We're already in one, Jim.
Yeah. You know, the professor was my professor 25 years ago, and he's an extraordinary man. He's an extraordinary investor. So I differ with him at my peril, but indeed I do differ with him. Look, I see where the first quarter GDP number came in, and we know that it had a lot to do with inventory adjustments. I see where the Atlanta Fed GDP estimate is for the second quarter. But here's the thing. If you're out and about in the economy, it does not feel like a recession. I don't care whether it's, you're in an airport, you're on a highway, you're in a restaurant. You look at jobless statistics, you look at ISM surveys, it's more, it feels like a recession because we're all talking about it. And by the way, that can actually create a recession. But if you look at the numbers right now that add up to where the economy is, it just doesn't spell recession to me. Again, I'll close by saying I differ with the great Jeremy Siegel at my peril.
That's fine. But what about if you're at the gas station where the real numbers are making people feel like we're already in a recession, or you're at the grocery store where you're spending so much of your paycheck that it feels like you don't have anything left after you go to the gas station and the grocery store. So for Americans right now, it does feel like we are in a recession. They don't care about the textbook definition either. And at some point, that's going to take its toll. That will be the shoe that drops next.
You very well could be right, Scott. And listen, I'm learning to dance with the fact that I could be wrong on my positive outlook. But regarding gas and food, which obviously and very unfortunately is eating into consumers' paychecks and really hurting the people who can least afford it, what we have to remember is at the end of the day, if you have jobs, that's the big if, which right now people do have jobs and a lot of job opportunities. then they have the money with which to spend. And it actually doesn't matter if it's on gas and food or a new tie or a new tire or whatever. It is the velocity of money moving through the economy that matters. That velocity goes down when people are unemployed. That's when they don't leave their house to actually travel and consume. Right now, the job statistics are pretty darn bright, and that's what's going to keep this economy going.